Starting February 12, the government will roll out a consumer price index series with a revised base year and an updated consumption basket. Here's what changes and why it matters. Let me take you through that. The Ministry of Statistics will release the new CPI series on February 12th. The base year shifts from 2012 to 2024, a long-awaited update aimed at making inflation data more reflective of today's economy. But that's not all. The GDP base year will also move to 2022-23, and the Index of Industrial Production, that is IIP, is also being revised, signaling a broader statistical overhaul. Under the new CPI, the household spending weights will change. Food, which currently has a high weight, is expected to decline. In contrast, transport, housing, your services are likely to get higher weightage. The consumption basket itself will be recalibrated, and for the first time, online prices, OTT subscription, and even airfares are expected to be included, capturing how India actually spends in 2026 and not 2012. Importantly, this does not change actual prices. It changes how inflation is measured. The broader revision will incorporate new data sources, your e-commerce, online prices, OTT, air travel, etc. Interestingly, this exercise is not about altering economic trends. It's about measuring today's economy with today's data. Why it matters to you and me is that CPI is the benchmark inflation gauge used by the Reserve Bank of India to decide interest rates. If food weight comes down, headline inflation could become less volatile. And for policymakers, investors, and markets, this reset ensures that the India's inflation data reflects today's economy and not some decade-old consumption pattern. In short, new base years, more representative data, and a sharper lens on the India's growth and inflation story.